You've seen that farmers cannot make an economic profit in the long run because there are so many of them. They produce essentially a homogeneous product and so forth. They cannot beat the market, in other words. They get what the market has to offer. They are price takers. Farming is about as close to the theoretical extreme of perfect competition as you can get, but also pretty darn close. The financial markets. The financial markets are at least large, well-organized financial markets have a lot of competition, lots of competition in there, lots of buyers and sellers. That makes for a highly competitive environment. And the question is, by studying the stocks and each company, okay, a stock, by the way, is just ownership in a company. It's slices of ownership. For example, if let's say a company is worth $1,000 and there are 10 shares of stock outstanding. So that means each share would be worth $100. You've split up the company into 10 parts, each worth $100 for a total value of $1,000. Okay, well, a lot of the large companies out there are worth billions of dollars, and they have thousands and tens of thousands of shares. So they're splitting up ownership among tiny little fragments called shares of stock. So the question is, can by studying the market, studying companies, all the thousands of companies out there, can you pick the companies that will beat the overall market? In other words, you get your portfolio of stocks. Let's say you studied the market, studied the companies, and you came up with a portfolio, let's say, of 20 stocks that averaged a 12% return. And the Standard & Poor's 500 index of stocks, that's usually the benchmark. There are a lot of indexes out there, but that's usually the benchmark that's used to determine whether you beat the market or not. But let's say the Standard & Poor's index returned 10%. Well, you beat the market. We'd say you got an economic profit of 2 percentage points. You beat it. Okay, can you do that? Can you do that on an ongoing basis? And the evidence is just like the farmers. Farmers may be able to beat the market from time to time because they've adopted a cost-saving technology or developed a cost-saving technology of some kind that other farmers don't have, or they don't have it yet. So you're able to cut your costs while the price of wheat or corn, whatever, stays the same. You might be able to beat that market for a while. In other words, make an economic profit, be better off than you could have been elsewhere. In this case, by the way, this is what you got, and this is what you could have had elsewhere. So the difference between the two is your economic profit. Well, whether or not you're able to do this depends in part on how efficient the market is. By market efficiency, we mean how quickly and accurately stock prices adjust to new information. So let's take a look. Let's do a little example of market efficiency. Let's suppose there's a big announcement coming up. Okay, here's the price of a stock, and here's these are days. Okay, day 0 is when the big announcement is going to come, and the The announcement is that they've developed a new technology that's going to add cash flows to the company. And so more cash flows to the company means more money, more profits, and that means the stock is more valuable. The company's more valuable, therefore its shares of stock are more valuable. So it's worth more. So this is the day the announcement is made. This is 10 days before the announcement. This is 5 days before the announcement. This is 5 days after. This is 10 days after. Okay? So let's say the stock is just going along like this. The price isn't changing. Okay? Just going along. 5 days before the announcement. Okay, nobody knows. Nobody knows about it. Except for, the insiders in the company. So we get to the big announcement, and let's say that the price of the stock is $10, and the new announcement, okay, the new technology is going to be worth, let's say $2 a share worth. So if after they adopt this technology, the cash flows come into the company, the new profits are going to be worth another $2 a share. So if the market is absolutely perfectly efficient, boom, if it interprets that information and it is perfectly efficiently processes that information, it's going to bounce up and then it's going to continue on like that. That is a perfectly efficient market. And in a market that is perfectly efficient like this, it is impossible to beat it. Okay, because it's going to process new information quickly and efficiently. Unless you're getting lucky. I'm talking about long term. Well, but it may not be perfectly efficient. It may look more like something like this. It may bounce clear up here where there's all this euphoria, People are excited. It goes nuts. And then over time, it just kind of goes down to where it really ought to be. Okay, or it could be a market just barely processes it and it just moseys on up there like that. Now that would be what we call not a perfectly efficient market in the short term. Okay, I realize I only have 2 days or 10 days here after the announcement. But going out long term, and I mean way longer term than 10 days, but eventually the financial law of gravity always prevails. Okay, sometimes we have bubbles where the price goes way, way above what it's worth. But eventually the financial law of gravity prevails and it comes down. It could take weeks, months, whatever, years. We had a real estate bubble in the early 2000s. We had a stock market bubble in the late 90s. And we may be in a stock market bubble here in the early 2020s. It's pretty high. Okay, it could be the euphoria over those vaccines. We had a recession because of the COVID-19. The solution to that was a cure, and maybe we've got it. It looks like maybe we do, with the vaccines being spread widely, and seems like COVID-19 is dying down, and there's just a lot of pent-up economic activity out there. So the disease was the disease, and the cure is the cure. So we very well may be in a bubble where the euphoria, we are so happy, is driving this thing clear to the sky. Well, if the market is less than perfectly efficient, there is an opportunity to beat it, obviously. If it processes the information very slowly, and through your intelligence and diligence, you identify this stock as being worth this much today after this announcement, yeah, you could hurry up and buy it down here and knowing that it's going to rise, up to this level. Or with a bubble, if you time it right, you get, it's up here, you can sell the stock short. That means you sell stock you don't own, you borrow it through a broker. Some other investor who owns the stock makes it available to the broker, and that lends it to you to sell. So you would sell it up here at this price and then go in the market and buy it at this price down here and make some money. So in that case, you're selling high and buying low. So there is an opportunity to beat it if it's not perfectly efficient. Now, evidence is it's not perfectly efficient. It's efficient, pretty darn efficient over long, in the long run, ultimately. So there is an opportunity to beat it, but still, you have to be able to figure out these movements. If it's perfectly efficient, there's nothing to figure out. You aren't going to beat it, period, ever. Well, the evidence is that there are some people who beat it from time to time. Investment managers, maybe a third of them will beat it every year, but it's never the same third. Almost none of them who beat it in any given year beat it the following year. So overall, the evidence is there are no economic profits in the financial markets, at least in the long term. Okay, this is not to say that financial analysts are dumb. Okay, this is not to say that farmers are dumb. No, farmers are experts in what they do. They know what they're doing. They understand the market they work in. They understand the product that they produce. They know how to produce it efficiently. And they're the best at what they do. The reason they can't beat the market is because it's so highly competitive. The same with financial analysts. There's all these analysts competing against each other. Here's the paradox. You can't beat the market because it's at least reasonably efficient. But why is it efficient? Because of all the competition among the analysts themselves. So, you often hear about analysts not being any smarter than just throwing darts at the stock pages to pick stocks. And you often see this exercise of this dart picking versus the portfolio the pros. So, if the market's efficient over the long term, why not just throw darts? Why not? Well, I don't want you to go out and pick your stocks by throwing darts. So there are problems with throwing darts. Let me just go over some of them. You could throw all your darts into one industry. The forces of chance could put you all in one industry. That would not be wise. You need proper diversification. And market efficiency, there's a misconception that market efficiency will keep you from making a mistake. That's not true. So the forces of chance can put you all in the same industry. You will have lack of diversification, and that is something you don't want. And keep in mind that smaller markets are not efficient. Penny stocks, some foreign markets are often not efficient, and information is hard to get sometimes, and you're taking a lot of risk in those cases. Now let me tell you a way to beat the market every time. Guaranteed to make economic profits. Here we go. We talked about the information. Here's the date of the announcement. It's worth this much. The new technology that is going to be adopted by this firm or created by this firm that's going to amount to $2 extra in share price in increased value. The way to beat the market every time, get the information ahead of time. See, this is when the announcement is made and it becomes public and the market responds. Well, if you could just get the announcement here or here, before this day, you will buy at this price, and then boom, or maybe boom, you've made some money. 100% guaranteed this is going to work. A flawless investment strategy. It is illegal. That is called insider trading. Yes, because, and it's surprising, you know what? A lot of, I shouldn't say a lot, but there have been a few very high-profile cases with high-profile investment professionals who were legendary in their ability to beat the market, only to find that they were paying for insider information. It must be pretty hard to beat the market if you're willing to take those risks. And these, insider trading, that is getting information that is not public. If you are in possession, or if you're an employee of the company, believe me, the Securities and Exchange Commission will be watching you carefully. They will be going over trades. And if they see that you bought a bunch of stock the day before a public announcement, they're going to be coming over and talking to you about how you knew. Why did you make that trade that day? What a coincidence that the market bounced up 20%. So you're going to have a pretty good answer. Anyway, yeah, that'll beat the market, but insider trading won't work. And the reason it's illegal is because if people think the markets are rigged, they're not going to participate, and that's going to dry up sources of funding for businesses, and that will be disastrous for our economy.